In this video, I'm going to walk through an example of evaluating different levels of debt for a firm that doesn't currently have any interest-bearing debt. The company we're going to be looking at is CODA Octopus Group. This company makes equipment for visualizing underwater areas. And currently, the company has a stock price of $5.77 per share. They have shares outstanding of 11,172,680. Their market capitalization is approximately $64.5 million. They have total assets of about $53 million. The tax rate for the firm is currently 17.10%. They don't have any debt outstanding, so their debt to capital, their long-term debt to capital values are both zero. The equity beta, or the levered beta for the firm, is 1.04, as well as the asset beta, and that's again because the firm currently doesn't have any debt. So we're going to be evaluating three different levels of debt for the firm, in addition to the current situation, which is the firm without debt. We're going to be evaluating the different levels of debt using different techniques. One technique is that we're going to calculate the break-even EBIT for the firm, and then use a moderate level of EBIT for the firm to evaluate the different levels of earnings per share for stockholders at the different levels of debt. From that, we're going to look at the values of the interest tax shield at each level. This isn't really to evaluate the different levels of debt because that interest tax shield will grow as the firm takes on debt, but it is to demonstrate how to calculate the interest tax shield at different levels of debt. Finally, we're going to be calculating the weighted average cost of capital for the firm at the different levels of debt. In order to do this, we're going to be using the following equations. So we'll calculate the break-even EBIT, and this break-even EBIT calculation tells us the minimum level of EBIT that the firm would need to earn in order for stockholders to be better off with the level of debt that we're evaluating. We'll also be using the Hamada equation to lever the betas of the firms to calculate the equity betas for the firms for each level of debt. We'll be using the security market line, and the security market line says that the cost of equity is equal to the risk-free rate plus the levered beta, or the equity beta for the firm, multiplied by the equity risk premium. And then finally, we're going to use the weighted average cost of capital equation that says that the weight of debt multiplied by the cost of debt multiplied by 1 minus the corporate tax rate plus the weight of preferred stock multiplied by the cost of preferred stock plus the weight of equity multiplied by the cost of equity is equal to the weighted average cost of capital for the firm. And our goal with this is to find the weighted average cost of capital that maximizes the value of the firm, which will be the weighted average cost of capital that is the lowest. So we want to find the lowest weighted average cost of capital based on the different levels of debt that we're evaluating. Okay. So I'm going to go back to the spreadsheet here, and we'll start with the interest expense calculation. So what we have here is different levels of debt, and what we're assuming is that the firm will take the proceeds of this debt and use it to repurchase stock. And so at each level of debt, we have a cost of debt for the firm. As you can see, it increases as we take on more debt because the default risk increases as the firm takes on more and more debt. And you can see down here with the debt amount of $38.7 million, the firm has a fairly high level of default risk at that point because that's more than the majority of the value of the firm's of assets. So it's more than half the value of the firm's assets there, or the firm's market value of equity. So it's quite a bit of debt for this firm. So I'm going to start off by calculating the interest expense by putting in equals the debt amount multiplied by the pre-tax cost of debt. And then I'm going to drag that down. And as expected, that increases as we take on more debt and as the cost of debt increases. The number of shares repurchased will be equal to the amount of debt divided by the stock price per share. Do that again. The amount of debt, I'll put in the right sign there, divided by the stock price. And we're going to lock that stock price into place by placing a dollar sign in front of the D and the 7. And I can drag that down now. So as we take on more and more debt, we're able to repurchase more and more shares. And now we're going to calculate the shares remaining. So I'm going to put in equals the shares outstanding with no debt, that's D8, and I'll lock that in place, minus the amount of shares repurchased, and I'll drag that down. And again, as expected, as we take on more and more debt, we repurchase more and more shares, and we have fewer shares remaining. Finally, our break-even EBIT, we'll use that equation that I showed you before, and I'll just pull that up here again. So our interest expense at that level of debt multiplied by the shares outstanding if the firm has no debt, divided by the shares outstanding with no debt minus the shares outstanding with debt. So I'll put in equals and open parentheses, the shares outstanding, and lock that one in place, multiplied by the interest expense, divided by open parentheses, the shares outstanding with no debt, and again lock that one into place, minus the shares remaining. You can also put in for the denominator there just the number of shares repurchased. It comes out to the same number. So for our first level of debt, the firm would need to have an EBIT of $3.255 million approximately for that to make sense for the stockholders. I'm going to drag this down now, and as we take on more and more debt, that break-even EBIT will increase. In general, if the EBIT is less than the break-even EBIT, the earnings per share will decrease for the stockholders if the firm takes on that level of debt. So what we've got here in rows 23 through 28 are the EBITs for CODA for the last 5 years. And you can see here it's pretty volatile for this company. And it kind of makes sense why the firm currently doesn't have any debt, because their operating earnings are pretty volatile. We can see here, even with the lowest level of debt we're looking at, which is still quite a bit of debt for the firm, the break-even EBIT is more than what it was in the EBIT was for 2023. However, it's less than the average and the median levels of EBIT over the last 5 years. So we're kind of in the ballpark of maybe having some debt would make sense for the company. We're going to assume that the EBIT for the firm will be $4 million, which is, again, kind of in line with what the average has been, although that the annual amount has been pretty volatile year to year. We're going to fill in the interest expense here. And for each level of debt, so for zero debt, there's zero interest expense. So we can actually just put zero in here. For the $12,900,000 worth of debt, right here, our interest expense was $651,450. For the $25.8 million, it was $1.935 million. And then finally, for the $38.7 million, it was equal to $3.6765 million. Our earnings before taxes then are equal to the EBIT minus the interest expense. Our income taxes are equal to the tax rate multiplied by that EBT. So I'm going to put in equals the EBT multiplied by the tax rate. I'm going to lock that tax rate into place. And then I'm just going to pull those two, I'm going to go down here and calculate the net income. Then I'm going to pull that all across. So the net income is equal to the earnings before taxes minus the income taxes. And now I'm going to pull this across. So what we can see here is as the firm takes on more and more debt, the net income decreases. And that's to be expected because they're taking on more debt and having to pay more and more interest expense. The earnings per share for the firm are equal to the net income divided by the number of shares outstanding. So I'm going to take net income divided by the number of shares outstanding. With no debt, the number of shares outstanding is this 11,172,680. For the 12.9 million, we're going to divide net income by the shares remaining here in cell H18. For the next one, it'll be divided by the value in cell H19. And then finally, in the last case, it's going to be that net income divided by the value, the number of shares remaining in cell H20. So as we can see here, taking on some debt here increases the earnings per share by 1 penny per share. And that makes sense. That goes along with that level of break-even EBIT. So our assumed level of EBIT at $4 million is greater than the break-even EBIT up here. And it adds a little bit of value for the stockholders because it increases the earnings per share slightly. Above this level of debt, the anticipated level of, or the assumed level of EBIT is less than the break-even EBIT, and we can see what happens in that case, that the earnings per share fall. So now we're going to calculate the interest tax shield, and we're really not evaluating the level of debt here, because this interest tax shield will grow, will increase as we take on more and more debt, because the interest tax shield is created because the firm isn't paying taxes on the interest that it's paying out to its bondholders. That gets deducted out of income before they pay taxes on it. So we're assuming here that all net income is paid out as a cash flow to the stockholders. And so our net income is our cash flow to the stockholder. Our interest expense is the cash flow to the bondholder, and the total amount is the sum of the two. The value of the interest tax shield is the total amount of cash flows paid out to investors minus the amount that would be paid out if the firm had no debt. So the formula I'm going to put in here is equal minus the total amount in row 46, and I'm going to lock this second one in place because since the firm has no debt in the first column here, the value of the interest tax shield is 0. But as I drag this across, the interest tax shield will increase because this is the amount of cash flows that we're paying out to investors in each year that isn't being paid in taxes. So taking on debt allows a firm to have more cash to pay out to investors, and typically those investors are the bondholders or the lenders to the company. And again, we can see here that that value grows as we take on more and more debt. The last thing we're going to use to evaluate the level of debt the firm should take out is the weighted average cost of capital. And as we evaluate the capital structure for a firm, we're looking for the capital structure that minimizes the weighted average cost of capital. So my first row here is my market value of equity. With no debt, our market value of equity is just the market capitalization for the firm today. And so that's going to be the value in cell D9. If the firm takes out $12.9 million worth of debt, the market value of equity will be the market value of equity today minus the amount of that debt, because that's the dollar value of stock we're repurchasing. So I'm going to take, again, the value in cell D9. And from that, I'm going to subtract the amount of debt we're taking out, because, again, we're repurchasing that amount of stock. So I'm taking the value in D9 and subtracting out the 12.9 million here. And now, because I locked in that D9, I can drag this across, to get the market value of equity remaining with every level of debt. In the next row, I'm going to calculate the debt to the market value of equity. So I'm going to take the value in row 35 and divide that by the value in row 51. And again, I'm going to pull this across. And we can see here it's approximately 0.25. With the $12.9 million worth of debt, it's 0.67 or 6667. With the $25.8 million worth of debt, and then it's 1.5 with the $38.7 million in debt. The equity beta, and I'll just go out here again to those equations. The equity beta is going to be the second Hamada equation. So we're taking the unlevered beta, which is the asset beta, multiplied by 1 plus, and then the product of 1 minus the tax rate multiplied by the debt to equity value. And again, in this case, we're using the market value of equity for our equity value. So I'm going to take the asset beta up here in cell D15, and I'll lock that in place. I'm going to multiply that by, and then open parentheses, 1 plus, and then open parentheses again, 1 minus the tax rate. And the tax rate is in cell D11. We'll lock that one in place. And then we're going to multiply that by the debt to equity value for each level of debt. So in this case, it's going to be the value in cell D52. And then I'm going to close parentheses and close parentheses again. And so my equity beta in this case is the same as my asset beta because the firm has no debt in this first column. Now I'm going to pull this across, and as the firm takes on more and more debt, we're going to see this equity beta increase. So now we're going to use the security market line equation to calculate the cost of equity. And so what I have in here are the risk-free rate, and this is currently the yield on the 10-year U.S. Treasury, plus, and then we're going to take the equity beta for the firm multiplied by the equity risk premium, which is currently 4.6%. And so I can drag this over, and as we see, as we take on more and more debt, because the equity beta is increasing, we're also going to have an increase in the cost of equity. The cost of debt is just that interest rate that we have up here, the pre-tax cost of debt. And in this case, that's a given. So what firms may do is if they're, oh, I apologize. For the first one, it should be 0. For the second one, it's going to be the 5.05. So those are the different costs of debt for the firm. The weight of equity is going to be equal to the market value of equity divided by the market value of equity plus the value of debt. And for this first one, our value of debt is again 0. So my formula here says D51 divided by D51 plus D35. So in this case, since the firm has no debt, the weight of equity is equal to 1, and the weight of debt is going to be equal to 1 minus the weight of equity. And I'll pull this across just so you can see what this looks like. As the firm takes on more and more debt, the weight of equity will decrease, and the weight of debt will increase. And so what we see here is that on our second level of debt, our weight of equity is 0.8, our weight of equity is 0.8, our weight of debt is 0.2. In the third case, our weight of equity is 0.6, our weight of debt is 0.4, and in our last case, our weight of equity is 0.4, and our weight of debt is 0.6. Our weighted average cost of capital then will be that the last equation that I showed you in our formula sheet, which will be equal to the weight of debt multiplied by the cost of debt multiplied by 1 minus the tax rate. And I'll lock this tax rate into place because we don't want that moving around when we drag that over. We have no preferred stock, and most companies in the United States don't have preferred stock. So we'll skip over the middle portion of that weighted average cost of capital formula. And now we'll take the weight of equity multiplied by the cost of equity. And that will give us our weighted average cost of capital for the firm. So currently, without debt, we would estimate that the weighted average cost of capital for CODA is 9.05%. If the firm takes on a little bit of debt, we see that we actually reduce the weighted average cost of capital, even though the cost of debt is greater than zero and the cost of equity increases because we're offsetting the higher cost of equity with a lower cost of debt. That will actually decrease the weighted average cost of capital at this level of debt. Pull that over one more, and now we see the weighted average cost of capital increase again. And that's because the additional risk taking on that additional level of debt is increasing the cost of equity and cost of debt by enough to push the weighted average cost of capital higher. And then in our last case, it goes even higher. So based on the assumptions that we have here, the stockholders of CODA would benefit if the firm took on $12.9 million worth of debt to repurchase stock, because that would increase the earnings per share and it would decrease the weighted average cost of capital for the firm. Please let me know if you have any questions about this video. Thank you.